All right, picking up from where we left off with the straight line method, we're going to look at double declining balance method. Now we still have the same fixed asset on our hands. So again, this basic information hasn't changed. We're still dealing with this information here, purchase price, 4-year asset with a salvage value of $10,000. And initially, we're going to work with the same acquisition date for the first example, January 8th. But here are some things that are different about this one. So immediately, you're going to see some things. Obviously, we have the same concept of year here, because again, we bought it at the beginning of January. But here's some big departures. First, we'll focus on depreciation base. Now, that's definitely different than what we saw in the straight line method. So again, going back to here, we're going to define depreciation base as book value, which is why the starting number is always equal to the cost of the fixed asset, in this instance, $100,000. Because remember, we haven't depreciated it yet, so it's always going to start at that $100,000. But a very important thing to consider is we did define a salvage value of $10,000, so we will have to abide that in later calculations. We can't go below salvage value. Think of it as a floor. Can't go through the floor. As soon as you get to the 10,000, you're done depreciating it. Doesn't matter what method we're talking about. So that's what this 100,000 in year one is coming from. Now rate, this one's definitely a little bit weird looking. 50% instead of 25%. Okay, so here the rate column is a product of taking our 100,000, or 100%, and this in this case times 2 divided by 4, or you can think of it as 100% divided by 4 times 2, whatever. The math works out the same. Again, this is where the double comes from. Double declining means we're doubling the straight line rate. Now the thing you'll notice there is the rate is constant. It's always 50% for each 12 months that we're talking about. All right, so we'll get to the other part of this one. So we're going to take our 50% of 100, and our depreciation expense in year one is $50,000. Now, that seems kind of extreme here. Again, let's contrast it with the first year of straight line, only 22.5 on that schedule. Now, again, this method of depreciation we're talking about here is called an accelerated method, and I just rubbed that right through, didn't I? Okay, here we go. Let's try that again. Hey, there we go. As opposed to straight line. In other words, remember, straight line is going to give us this. Honk shoe, pretty boring, right? Straight line, it's constant. Is that necessarily consistent with how fixed assets lose value, though? No. Fixed assets tend to lose most of their value when? At the beginning of their life, right? In the early years and later, in later years, it lose less because there's less to lose, right? So, in other words, this is how most fixed assets really lose their life. They lose it like that. Their value goes down from a lot in the early years. Again, we're talking about money here, and I'll just put a T for time there. Leave Tim alone, and then again, so as time goes on, depreciation we're going to get smaller and smaller because that's more consistent with the way it's really losing its value. Now there's another complementary idea here that I'm going to throw at you. Just try to bear with me. What happens to maintenance expenses over time? They go this way, right? They get larger. As it gets older, it costs more to maintain. If you take the data points on these two lines and you graph them together, you actually get a more consistent straight line of total cost over the life of the fixed asset. If you add those two ideas together, how much value it's losing from what you paid for it, plus cost of maintenance, if you add it together, it actually gives you, and again, the theory is a smoother impact on your net income in total. Right? So that's one of the ideas behind these accelerated methods. All right, so back to the example. So accumulated is going to equal 50 at the end of the first year, and our book value is going to be 100,000 minus 50 also equals 50. So what you'll see in this example is the asset's going to get spliced in half. Now again, that takes care of the whole double stuff here. What's this declining part? Well, obviously, if we kept depreciating it like this, 50% of 100,000, we depreciate it to $0 in 2 years, which is, again, whoa, that's a little fast, right? So how do we slow that a little bit? We'll go back to what I said. Oops, went the wrong way again. All right, so here we go. So again, depreciation based under this is defined as book value. So ask yourself, what's the book value at the end of 2019? Well, it's right there. It's under the column book value, $50,000. So what we're going to do here is we're going to say, okay, since that's what the book value was at the end of the previous period, that book value, that circle got a little larger than I wanted, becomes the next period's depreciation base. So that's the declining part here. I'll just kind of neaten that up and try to draw it a little bit less aggressive if possible. Oh, there we go. A little out of control at the end with the loop, but whatever, close enough. So now we're going to take 50% of $50,000 and we'll get an additional $25,000 in 2020. So now our accumulated 75, book value is 25. So what you'll always observe with this method is that the depreciation we take in early years is greater than straight line, and in later years it's less than straight line. Because it really becomes a matter of not if, but when. When are we taking that expense? So now our book value diminishes to 25,000, so that's going to be our depreciation base for 2021. So that's where that came from. And now we take 50% of that, and we're going to get $12,500 there. In other words, that's going to go down, just backing that off so you can observe it. So now, again, this is so we're just like I said, it's now below straight line. Straight line's 22.5. We're at 12.5 in the third year, so that's our accumulated minus 100,000. So it's only worth $12,500 at the end of 2021. So that becomes our depreciation base for 2022. So there it is, right there. Now, if we took 50% of that, we would get this much. We'd get $6,250. But what's the problem? That would also render a salvage value, or a book value in this case, or an implied salvage value, you can think of it that way, of $6,250. But remember, we defined a salvage value at 10. We cannot go below the floor. So because of that, we were limited in the last year to just taking an additional $2,500 worth of depreciation expense. So in other words, the math here is we're going to force this calculation here. So it's going to be book value at the end of 2021, which is our depreciation base, minus the $10,000 equals the $2,500. In other words, we're going to force that $2,500 to be a true statement. So that what is true? So that our accumulated depreciation maxes out at 90 as promised. Again, that's our depreciable cost. Be higher than that. And our ending book value can't be less than salvage value, which is 10. So that's one of the quirks of this one you got to pay attention to. All right, so same as before, we're going to look at an example where we purchased it when? In April 19th, 2019. So we're in the same boat as we were with the straight line example. We're going to have to do a little prorating. We're going to have to take 8/12 of our 50%, so we get 33 1/3, or 33 1/3 if you heard Pat Foley say that. A little quick sidebar on that matter. He's actually emulating somebody he grew up with, so that's kind of where he got that whole bit from. It's not original to him. It's kind of an homage to somebody that he grew up with. Anyways, back to the matter at hand. So again, it's expressed as a less than elegant repeating decimal. 33.3 bar goes on forever. And also we don't get a real, went the wrong way again. There, I'll get it right. Yeah, there we are. So again, our depreciation base is going to start in the same place, 100, but now we're going to take 33 1/3, so basically 1/3 of 100,000. And again, I'm going to be doing a lot of rounding here to whole dollars. So our depreciation expense in the first year is going to be $33,333. That's really hard to say in this example. Oh, well, I kind of trapped myself in this one. A lot of repeating numbers that get a little bit difficult to pronounce. So our accumulated depreciation is equal to that. Simplify it. It gives us a book value of 100,000 minus that 5 3s. So we get $66,667. Again, rounding our dollars like that. So that, same as before, that book value at the end of 2019, again, that's only 8 months we're talking about, is going to be our depreciation base for 2020. Now we can resume using that 50% rate for the next 3 years. That's going to be half of that, which basically gives us the same depreciation as 2019. But remember, this is now for 12 months, not 8. So it's the same amount, but it's really not the same per month. If you figured it on a per month basis, it's actually less. It's actually gone down. So we get another 33,333, leaving us to accumulated depreciation of $66,667, rendering us a book value of, good Lord, more 3s, 5 3s again. So it really does kind of haunt you in this one. That becomes our depreciation base for 2021. So I'm going to draw the line there. So we got our 5 3s all lined up, times 50% of that is going to give us. So now we're below straight line in that year, 2021. Now we get $16,667. So our total accumulated is going to climb up to $83,333, more threes, rendering a book value of, again, $16,667. This is our basis for depreciation in 2022. And guess what? We're now going to be in the same position as we were in the previous example, where we don't get to take the full calculation. The full calculation, half of that, 16,667, is going to be this, 8,333. And again, we can't take that because why? Because we're limited here. In other words, this can't go below the 10, same as before. We're going to take this 16,667 minus the 10 equals, we're going to force this amount of depreciation expense there to equal $6,667, giving us accumulated depreciation topping out at 90, and again, book value sits at 10,000. So basically, we take no depreciation expense at all in 2023, but I do give you what if we didn't give a salvage value here, because in theory, you can never have a salvage value of 0 under this one, right? There's always something left over, like a half-life idea. So if we ignored that limitation there, we would take our 8,333 in 2022, and we would take an additional $1,389 in 2023, and again, our rate for that one would be defined as, and I went the wrong way again, there we go, would be what? As 4/12 of 50%, so we get 16.67 or 0.6 bar there, repeating decimal again, and all kinds of wrong way examples going on here. Wonderful. Right, so we would get, so it's just a function of taking the 8,333, 50% times 4/12, which would render an ending book value of 6,944. So as promised, you're not going to get nothing there, right? It's impossible. There'll always be something left over. Okay, so that takes care of double declining balance method. There's one more method up, and that blank screen you've seen a couple of times, it will be filled up in just a moment. And we've arrived at the last slide here. And this deals with the third and final depreciation method, units of production, or sometimes it's now called units of activity. So in this case, instead of depreciating on the basis of like time, we're only going to depreciate when we actually use it. So you should really only limit this to assets. Obviously, you have to limit it to assets where you can do what? You can figure out a unit measurement. There's some sort of capability of saying, how much can we use this? Vehicles, equipment, conveying systems, and the like, something where you can measure actual activity, otherwise you can't use it. And usually they would say that you should only use this for assets that are probably used unevenly, like if you only use them occasionally, and like sometimes there's a lot of usage and then it gets a little lighter, whatever the case may be. That's not strictly what you have to do in practice, but it's probably a recommendation, I would say, more than anything else. Right, so one thing that you'll notice here, so we're going to have the same 100,000 dollars that we paid for it minus the same salvage value of 10,000. So in this case, 90,000. So this one defines depreciable cost equals its depreciation base, same as straight line. So they're equal in that case. Now we're going to set, in this case, the useful life is going to be set to 100,000 miles. So again, that's a departure. So if we assume that it was driven 20,000 miles in 2019, what's depreciation expense for that year? So again, there's our depreciation base, which is the same as depreciable cost, $90,000, and we're going to divide it by 100,000 miles. So in other words, we're going to depreciate this at the rate of 90 cents per mile. 90 cents times 20,000 miles equals $18,000 as the total depreciation expense we'll take in 2019. Now, here's something that you may have noticed I didn't mention, because it doesn't matter. When did we buy it? January? April? Some other month? Who cares? All we care about is, did you use it? If you did actually use this asset, then you depreciate it. Absent usage, you don't take any depreciation. So that's one of the good things about this method, is you don't have to worry about half-month convention or any other such, adjustments to your calculations. It's just going to be how much did you use it times your rate per increment, whatever that increment of usage is as that you've defined is, and you're done. Now I'm just going to follow through on the idea of this again. Let's say you've depreciated it $85,500 through 2021, and we're going to drive it 25,000 miles in 2022, how much depreciation expense can you take in that year? All right, so let's just figure a couple of things here, a little reverse engineering here. So we know that we had set this at 100,000 miles as our maximum amount of miles that we could take and depreciate it. How many miles have we driven it to date? There's a way to figure that, isn't there? If I give you how much you've depreciated it so far, that's accumulated depreciation, divided by 90 cents, I'm just basically reverse engineering where you got the 85.5 from. That means you've driven it 95,000 miles, because how did you get 85.5? 95,000 times 90 cents equals 85.5. So that's where that came from. So that means you've driven it 95,000 miles to date. So that means how many additional miles could you depreciate it in 2022? Only 5,000 miles. That's it. 5,000 times 90 will get you 4,500, and of course that makes sense, doesn't it? 85.5 plus 45 equals our 90, our depreciation base and our depreciable cost. So in other words, every mile driven beyond that, the next 20,000, you were done depreciating. You could not take depreciation on that. So if you looked at this asset on the books, you'd see what? Accumulated depreciation of 90 and a book value of 10,000, same as the other examples. So we always have to observe that limitation regardless of what method we're looking at. So just my conclusion here was, like the other two we mentioned, ending book value cannot fall below salvage value. The end. That's the way it works. And that also concludes the final video installment for Chapter 7. So I hope you got something of value out of these videos that I've put together here on this nebulous whiteboard hanging in space somewhere. See ya.